All right, we're going to begin with the Asian markets. Japan returning from holidays yesterday and leading the way on the Asian indexes ahead. I think it was 3.54% growth, bouncing back from the bloodbath that we saw last week. So we're going to get those figures up in just a moment as we look at how Asia has been reacting to a number of macroeconomic headwinds with respect to what traders are expecting with inflation. Here we go. So you've got the Nikkei 225, 3.45%. Shanghai Composite Index over in mainland China down by 19 basis points. Your Kospi in Korea is up by 10 basis points there. Hang Seng down by 13 basis points. The ASX S&P 200 in Australia, that was up. So it's a mixed bag over in Asia. I've got a number of other headlines coming out from Asia, including Singapore's GDP growth and also Total Energies exiting Pakistan. Let's cross over to Coventry, where we're joined by Eronmosele Aziba. He's a financial consultant that covers the Asian markets. Eronmosele, good to see you again. Good morning to you. Thanks for joining us. How are you assessing the Asian equity markets performance today?
Thank you very much, Curtis, for having me, and good morning. The past week has been quite volatile in the Asian market. We saw, like you said, a bloodbath in the market in the previous week, which was largely triggered by developments coming out of the US. So we saw the job numbers released last week, and the creation of new jobs wasn't in line with expectations. It was actually quite significantly below. And that sort of raised a lot of concerns about the broader US economy and potential fears of the economy slipping into possible recession. And then actions that could then be taken by the US Fed. So that sort of negative news that was coming from the US sort of permeated through different markets, even in Europe and particularly in Asia as well, where we saw quite a number of sell-offs. And then even more specifically in Japan, we also had the Bank of Japan increase its interest rates to 0.25%, which was, I think, only the second increase that we've seen since about 2010, thereabout. So there were a lot of activities that were going on that spurred knee-jerk reactions from investors that led to the sell-offs. But what we've then seen since then, leading to now, is investors are then taking a step back and, like, beyond just those like immediate reactions to recent news, taking a step back and looking at the actual economies. Have the fundamentals of the economy changed? Not necessarily, or they didn't necessarily change in that one day that the data came out, and we've sort of seen a rebound in the market, such that we've even seen circuit breakers also being used in this period as well, just because of the volatility that we had seen in the market. In the next couple of weeks, we're still expecting some additional data reports to come out, inflationary figures from the US as well, and in some of the Asian markets. And investors will likely be looking to these to get a clearer sense of where these economies are, and that will be reflected in trading activities.
Fantastic. You mentioned inflation. We're getting a whole lot of inflation this week. You mentioned the US, tomorrow the UK, Nigeria on Thursday. We got India yesterday. I think it decelerated to 3.45%, lowest in about a number of years. What do you make of the inflation trajectory over in India as far as the triggers for the numbers that we saw?
Interestingly, I'm sure the first question will be in our heads would be what we would give in Nigeria to have those levels of inflation, considering where we currently are, right? But in India, so we saw the inflation levels yearly inflation levels come below the 4% upper limit that had been set by the monetary authorities there. But it was largely tied to the effect of a high base. So essentially, in the previous year, we had significantly higher inflation levels, and when you consider what its current consumer price index level is relative to what we had in the previous year, we can see that base effect sort of come into play. And as a result of that, we had like a lower year-on-year increase in inflation. So the ease that we're seeing is largely tied to that sort of base effect that we've seen from the previous year, and not necessarily any like significant changes that have occurred in the economy. But just on that as well, there are also a lot of investors are also looking towards what the monetary authorities would do with regards to its current monetary policy stance, and where their benchmark interest rates might lie, if we'd see any potential cuts or any raises in subsequent months in the year.
Now, I want to get to, we've gone from Japan, we've gone to India. I want to get to China now. The OPEC monthly oil report for August, China was a concern. They mentioned that with respect to their downgrade for oil growth demand. So what's the thinking there with what's happening with China and its impact on oil trajectory?
So with China being one of the major importers of this oil product, it cannot, as an economy, cannot be overlooked. And we know that the Chinese economy has also been challenged with a slower pace of growth, and the ripple effect has been seen in the oil market as well. With from the OPEC meeting, the projections for oil growth have been revised downwards to about 2.1 million barrels per day from about 2.25 that it had initially set, because data that is coming out of China is suggesting that the expected demand from that market might not be at the levels that were initially thought earlier in the year. And this also speaks to the OPEC's ability to start to trim its production cut plan that has been on. There were expectations that with the increased demand for oil later during the year, we might see OPEC sort of loosen the taps a little bit and reduce the level of cuts that it had initially planned. But with this slower data that is coming, it's slower economic growth data that is coming out of China, it's sort of influencing that decision. But it's interesting to note that while the OPEC has set its projection for growth at about 2.1 million barrels per day, the International Energy Agency is significantly lower at sub 1 million barrels per day. So there's that wide gap even in the projections for oil demand, and it's largely tied to what we're seeing coming out of China in terms of overall global growth demand. So a lot of policymakers and analysts as well will be looking towards the Q2 actual demand numbers when they start to come in, so we get a better sense of what demand was actually like, because oil data tends to be a lagging data and significantly affect the ability to project demand for the year. So we still expect to see more revisions to these projections in subsequent months.
Thank you so much for pointing out the discrepancy between OPEC and the International Energy Agency. I think we'll get the IEA numbers, the revised numbers later on today. But yeah, big gap between the two. Singapore, let's touch. I love this Asia tour that we're going on this morning. Singapore GDP growth coming in Q2, I think 2.9%. They are moving in the opposite direction of OPEC. They are forecasting higher growth. What's the reasoning there with regards to them being more optimistic about growth in the future for Singapore?
For Singapore, we know it's a largely trade-based economy. Earlier in the year, they had set a growth projection of between 1% to 3%. now with this revision, whilst the upper limit still remains at 3%, the lower limit has been increased to about 2% thereabout. And this is because of some of the numbers that they're seeing from manufacturing sector. They're seeing increased activity in there in terms of their projections for trading activities with their major partners. I think China and the US are, top of that list. They're also seeing some increased activity in that space, and that is what is fueling this. That's what's fueling this revision upward revision in a way to their expectations for growth. They've gotten Q1 numbers now, and they've gotten second quarter numbers as well. So they've gotten a clearer sense of how the economy could potentially perform. But despite this revision, there are still downside risks that continue to prevail. So, for instance, I mentioned that the US remains one of their major trading partners. If we're seeing slower growth in the US, or the economy eventually slips into a recession, possibly. I mean, now we've seen some analysts give us high as 25% chance of the economy slipping into a recession. If the US economy actually does slip into a recession, that has a resultant effect on trading activities as well. So there could potentially then be a further revision to what we're seeing from Singapore. But at the moment, it's based on what we've seen from the first half and their projections for what could happen with their trading partners in the second half of the year and their manufacturing sector, and they're expecting that to improve.
All right, well, I've only got less than a minute to go. Just very quickly, everybody keeps talking about how companies are leaving Nigeria. Pakistan looks like it's a basket case right now. Total Energies, the latest multinational to signal an exit from the country. I think there are about 8 or 9 more that are leaving Pakistan. How bad is it over there?
So again, Total Energy is one of about 9 companies that has recently announced that they were leaving or that has exited in the past year. With a multinational company, one of the most important things for them is currency stability and the ability to repatriate their funds. Now, in the local Pakistani economy, there's been heightened political instability in there. It's also, in terms of the currency situation, companies have found it a bit more difficult to repatriate their funds as well. And that has been a major cause for concern, which has sort of triggered this exodus of firms that we're seeing just because of the uncertainty that is prevalent in their economy. We're seeing these companies just look elsewhere and look to exit the market.
Fantastic stuff. Eronmosele Aziba, financial consultant, thank you for the Asia tour. We really appreciate your time this morning joining us from Coventry. Take it easy.